Every time the Federal Reserve meets, millions of investors hold their breath. They analyze every sentence, waiting for a few words about interest rates or inflation to decide their next move. But this daily noise is a distraction. While the public watches the news, a hidden structural clock has quietly timed every major economic cycle for over 200 years. It's known as the 18.6-year cycle. This mathematical rhythm accurately predicted the Great Depression and the 2008 financial crisis. Based on this timeline, the volatility emerging in mid-2026 marks the arrival of a programmed financial window, the most dangerous phase of our lifetimes. The foundation is astronomical. Analyst W.D. Gann aligned market turns with the 18.6-year precession of the Moon's orbital nodes. These shifts in gravitational forces correlate with human biological markers, specifically melatonin and cortisol levels. Scaled across millions, they aggregate into predictable waves of economic optimism. When collective optimism peaks, it ignites aggressive land speculation. Because land is fixed, every surge in demand capitalizes directly into skyrocketing property values. Banks respond to rising values by loosening lending standards. They pump fresh credit into the system to fuel new mortgages, creating a self-reinforcing debt loop. Welcome to the winner's curse phase, 2 years of extreme market euphoria, fueled by toxic leverage and asset prices decoupled from reality. This loop is a closed system. It always concludes with a mandatory 4-year collapse when the credit supply can no longer sustain the accumulated debt. In the 1930s, economist Homer Hoyt analyzed a century of Chicago land values, stretching all the way back to the 1830s. He discovered that property peaks arrived on a precise, relentless 18-year schedule. The rhythm continued with lethal accuracy. The mathematical progression predicted the 1925 real estate peak and the subsequent 1929 market crash. From there, the clock jumped forward 18 years from the 1973 bust to trigger the 1990 real estate recession. Adding 18.6 years to the 1990 peak, analysts using this model forecasted the 2008 Great Financial Crisis, years before the first subprime loan failed. This pattern has persisted through centuries of changing political systems and monetary policies. While government actions influence crash intensity, the underlying 18-year rhythm remains the structural baseline for every major debt unwind. If we project exactly 18.6 years from the previous speculative top in October 2007, the arc lands in mid-2026. The recent tech and real estate booms were the final expansionary symptoms of the winner's curse. That euphoria is now exhausting itself as the cycle's momentum rolls over into contraction. This specific window is dangerous because of a double-cycle convergence. The 18.6-year top is synchronized with the bottom of the shorter 3.5-year stock market cycle, creating a massive downward pull. We can already see the real-world catalyst, a multi-trillion-dollar commercial real estate refinancing wall. Highly leveraged property owners are now being forced to refinance at punishing rates, just as global liquidity begins to contract and delinquency rates climb. Linear economic models are failing to map this danger. Within the next year, 99% of the market will likely be caught off guard by a severe secular contraction. The instinct for retail traders will be to buy the dip, but history suggests that those who mistake a structural collapse for a routine correction will be wiped out. Institutional strategy for this phase shifts away from aggressive growth. The focus is now entirely on capital preservation and structural liquidity. During the 4-year down cycle, rotating into hard assets provides shelter from banking failures and the currency debasement that often follows a systemic reset. The ultimate goal is to hold liquidity to deploy at the absolute trough of the cycle, projected between 2028 and 2030, when distressed assets will be liquidated at deep discounts. For most, an 18-year crash is a tragedy, but for those who follow the clock, it is a mathematically timed mechanism for generational wealth transfer.